Welcome back. We have another installment of What Are the Odds? We're going to take a look at probably a little lesser known of a tool among traders, but something that's been used for a very long time. It's the gold silver ratio. Essentially, what it is the calculation of 1 ounce of gold versus 1 ounce of silver. Now, in our example, we have gold, which is $1,800 an ounce, and silver is $25 an ounce. Simply divide the price of gold, 1,800, by the price of silver, $25 an ounce, gives us a ratio of 72 or 72 to 1. Historically, an average gold silver ratio lies around 55 to 1. This varies. Some will say 50 or 60, but 55 to 1 is most accepted average of the gold silver ratio. Now, the way we use this is gold has a more relative value when the ratio is below 50. We'll see the gold silver ratio 20, 30, 40. During those period of times, gold tends to be a better buy. When we see the ratio above 60, such as 70 or 80, then silver seems to be more of a value. Now, we'll take a look at our historical charts where we see here the yellow line, I should say, is the price of gold going back to the year 2000. The green line is the price of silver. These two metals tend to work in tandem. However, they do differ from time to time. And the black dotted line represents the gold-silver ratio. Now, the reason why these two metals will differ in movement from time to time, gold is typically used as a pure inflationary hedge, meaning that when we see inflation, and we see the dollar is moving higher, gold tends to go down. However, when the dollar goes down in a period of deflation, then we start to lose our value holding our capital in dollars, in US dollars, and then traders will move their money out of the US dollar and into gold. So when the dollar goes down, gold goes up. Silver works in the same way, but silver also is used in jewelry, electronics, and a lot of different industries. Gold as well, but silver to a greater extent. Generally speaking, silver tends to perform better when the stock market and the economy is stronger. Gold tends to do better when the dollar goes down and we're reaching or we're approaching points of deflation, lower prices. Now, take a look at what we've seen over the past couple months. The blue line represents the price of gold. As the Federal Reserve has been raising interest rates, the dollar goes up and the price of gold has been going down. As that has occurred, obviously the gold-silver ratio has gone down. Now, it hasn't gone down in tandem, but generally speaking, there is a positive correlation. When the price of gold goes down, the gold-silver ratio goes down. During the same period of time, well, really quickly, let's take a look at the performance. Now, what we can look at here is a 7, 14, 30, 60, and 90-day projected performance. This represents the maximum amount of money that you could have made over 7 days, 14 days, etc. if you were to purchase gold at a certain gold-silver ratio. So, for example, when we see here a gold-silver ratio around 80, historically speaking, and this goes back several decades, our data over here, the 90-day performance is around 8%. Now you'll notice the bars, the histogram bars, really start to go to the upside when we go above 80. It's important to mention why this is happening. During the major stock market sell-off that we saw 2019, the 2020 level, the gold-silver ratio broke above 80. Almost never happens that the gold-silver ratio breaks above 80. But silver very much sold off, and gold definitely outperformed silver. This is an anomaly. This is not something that normally happens. Normally, historically, over the past, let's say, 100 years, the gold-silver ratio tends to remain between the 20 and 80 level. So it is important to recognize we are going to see this data when the gold-silver ratio goes above 80 and especially above 90. But that was a very, very unique circumstance. Doesn't mean it can't happen again, but it's not something that's certainly very likely. Now, with that said, when we see the gold-silver ratio go to around 100, which we did a couple years ago, all of a sudden now we see the projected returns, or I should say not projected, the historical returns are near 20%. And as the higher that the gold-silver ratio goes, that indicates how much higher. That is because of that that really that unusual period of time we had in the market. So it's not something that I would necessarily count on happening in the future. But overall, excluding any figures above 80, we tend to see gold actually performs the best when we see the gold silver ratio between the 30, 40, 50 level. Then we see a 90-day historical return near 25% if we buy gold with a gold silver ratio on 30. Now, the same, except of course of the opposite point of view, holds true with silver. The red line over here represents the gold silver ratio, the purple line represents the price of silver. And we generally speaking, we tend to see an opposite or inverse correlation. When silver goes up, the gold silver ratio goes down. This is logical because of the math dividing gold by silver. Take a look at the performance now. We tend to see, of course, the numbers are very much skewed when we see a gold silver ratio above 80. But we also tend to see the gold silver ratio perform better at 75 than it did at 70. Now, it's a little bit inconclusive on this type of chart to show how silver is a better buy than gold. However, doing the math, we do tend to take a better position with the gold silver ratio when we're buying silver when it's at the higher end. Now, we do see higher performance numbers when the gold silver ratio is lower, near the 35 to 40 level. But keep in mind, our math is calculating a 7-day return, a 14-day return, even a 90-day return. The difference in the metals, especially gold and silver, as opposed to many other markets like the stock market or bond market, it's a very slow-moving market. So while we can calculate that we can say, hey, 90 days forward, how did the silver market perform when the gold-silver ratio was near 35? Looks like it did better than it did in the 70s and 80s. But the problem is that because the market is so slow moving, that when we see the gold-silver ratio go down to 35, it may stay there for 6 months. It may stay there for over a year. The metals are a very slow-moving market. So I wouldn't really let this math deceive us. We can take a look at the gold-silver ratio compared to the S&P 500. The stock market, the S&P 500 is the orange line. The blue line is the ratio. We tend to see a positive correlation. That's just the dynamic in the way the markets perform, and we can see exactly how this math works out as well. Again, excluding the figures that breach above 80. Why did we include them? Well, it's important to visualize to see exactly how much numbers were skewed. But if we exclude that, we tend to see the S&P 500 has a better 90-day performance, for example, when we have a gold-silver ratio in the 70, 75, 80 level, as opposed to the 40s and 50s and even below that. And keep in mind, historically, the average price is right around 55. So if we draw a line right here, we can say, well, it certainly looks like the stock market performs or tends to perform a lot better when gold is stronger than silver, so to speak. And then finally, of course, we can also compare silver to gold itself. Now, what we're doing here is we're subtracting the gold performance from the silver performance. They're also not equally measured. Gold is $1,700-$1,800 an ounce. Gold is $1,700-$1,800 an ounce. Silver may be $20 or $25 an ounce. So we're going to naturally see better percentage returns from silver. If silver moves from 20 to 25, that's a much bigger percentage move than gold moving from 1,800 to 1,830, for example. So overall, silver does have better performance when it goes up. Obviously, also worse performance when it goes down. But we'll tend to see over here, again, because of the slow-moving dynamic, the math doesn't really do it justice, meaning we'll see better performance returns near a lower gold-silver ratio, but I don't believe that this is true. Historically speaking, we tend to do better buying silver when the gold-silver ratio is above 60, the 60 to 80 level. And we tend to do better buying gold when the gold-silver ratio is in a lower quadrant, meaning below 50, the 40-30 level. But generally speaking, we want to always take a look at to see where the ratio is. And again, it's very simply the price of gold divided by the price of silver. And historically speaking, we want to buy silver when the gold silver ratio in this case is very high, near the 80 level, such as 2008. You'll notice this also coincides with major market sell-offs. Major market sell-offs, so we saw in the early 2000s, 2008, most recently in 2019, 2020, silver tends to be a better buy. But when the stock market is strong and the economy is strong, traders tend to look for more value in buying gold, and we want to see the gold-silver ratio near the lower end of its spectrum. If you like this approach, if you like using historical data to try to make the best trading decision moving forward, I'd encourage you to also look at our other video we recently posted, trading the VIX according to its odds as well, and I'll post a link right here. And we hope this has been helpful in guiding you in your metal trading moving forward. We thank you for joining us. We wish you a great day.